everyone. Thanks for joining my presentation today, and thanks for having me on Startup Grind. A quick intro on me. Steph Choo, I'm partner at a fund called Portage. We are a fintech-focused venture fund. I'm based in New York, and we invest in the future of financial services. If we go to the next slide here, we can see a selection of my portfolio companies, which I think is the best way to talk about who we are. We invest really across consumer fintech and across B2B fintech, primarily early stage investors. So really seed to B. And we write lead checks that range from, call it $5 to $25 million. We're now investing out of our third fund, which is a $650 million vehicle. So what are we going to do today? I'm hoping to do three things today. So first is to really just talk about the market and give you guys a view of what we're seeing from the investor perspective. So two, really give you a peek behind the VC curtain. So give you a sense of what we're talking about at our own partners meetings and conversations that are happening around the table. And then three, share a few practical tips for you guys as founders and really what we're telling our portfolio companies from the boardrooms. So why don't we jump right into it? I wanted to start with the big overall view of the market. If we go up kind of 10,000 feet here, what we're seeing here is quarterly venture dollars over the very left-hand side of this bar is kind of 2017 up until now, Q3 of 2022. You can see the quarterly funding numbers for 22 have really dropped 36% quarter over quarter, almost 50% year over year. But the thing I really want to highlight here is actually that we're back to funding numbers that really range from 2018 to 2020. So it's not like funding is completely gone. Deals are definitely still getting done. Dollars are being deployed in the venture ecosystem. And if you really look at this chart, it's really 2021 that was the aberration over the last decade. Obviously, we've seen a tremendous bull run, but deals are getting done just really more at the rate of 2018, 2019, and 2020. If we go to the next slide, you can see quarterly deal volume here. And so the story is actually quite similar. So a big drop quarter over quarter, 10%. We're in a 7-quarter low in terms of number of deals getting done. But again, I want to highlight that really we've gone back to numbers from 2018 and 2019. So it has been a precipitous drop off since 2021, but really, again, deals are still getting done. Anecdotally, I can tell you if you split the numbers and the share of deals across seed all the way to Series D, the biggest drop off is, of course, in the later stage investing environment. So Series C, Series D, there's not a lot going on, but seed and A markets have actually remained pretty robust as a share of deals. The seed and A stage is actually larger than it has been for the last few years. Now, if we look, I think everybody's asking what's going on with valuations. Private market venture valuations follow public market valuations. The blue bar here is a look at SaaS multiples. It's really a B2B cloud index. The red bar here is an index of public fintech companies. That's a blend of both B2B and B2C companies. Multiples have dropped in the public markets 70% from their highs in 2021. So before, when we were seeing things trading from 12 to 15 times forward revenue, were real, and the best performing companies, by the way, were trading at 50 to 100 times revenue in early 2021. We've now seen things in 2022 drop by 70%. We're now, median multiples now look like 4 to 9 times revenue, which is a pretty different market environment than before, clearly. But I will say again, if you are a company trading with great high gross margins. You're with great gross margins with really high growth, so over 50 to 100%. You are still going to be trading at 25 times plus multiples. So the second thing I want to point out here, I know this chart only starts at 2020, but if you move backwards in time, the 2022 multiples actually look pretty similar to pre-pandemic levels. So again, 2018, 2019. So really what we've done is wipe out, I guess, 2 years of gains, but 2 years of gains, but we're really back to where we were 3 or 4 years ago. And I can tell you the private markets, of course, follow the public markets. So what does this mean for venture itself? There's definitely been a valuation impact in investing, but again, it's mainly happening at Series C and Series D. I would say Seed and A were mainly insulated earlier in the year, but now we're starting to see some impact. Of course, in this kind of market environment, there's always going to be a handful of exceptions. So if you are a founder at the seed or A stage, that's a repeat founder that's been there, done that before, you probably are going to be able to raise at similar or maybe slightly lower valuations than last year. But of course, it's very situation dependent. But I would say the median valuations across the industry, including in venture from seed onwards, are now certainly lower than they were last year. And I'll talk more about that in a couple of minutes. So if we look now at the IPO market, you can see there's lots of impacts here on the IPO market. The IPO market's down. I would say realistically, this is a lagging indicator on the page. The IPO market's basically shut, and this is going to impact how VCs think about exits. M&A numbers have dropped a little bit, but they're actually still double or close to what we saw several years ago. I actually think the M&A markets are going to continue to be pretty robust because there aren't really other options for companies to exit now that the public markets, as you saw from the past pages, are actually pretty much closed. But exits, if I were to kind of predict, I think the M&A market is going to continue to be pretty robust. So, but I hear this a lot, which is, isn't there money everywhere? Aren't there still a lot of VCs waiting on the sidelines with dry powder? And you can see this page here, which is in 2022, there's an estimate that dry powder sitting on the sidelines is kind of significantly more than 2021. There's still $300 billion estimated. But I would say there's a couple of really interesting dynamics at play that are worth highlighting, because this chart really doesn't tell the full story. First, most of these are just estimates, and they're built really bottom up, and they're really lagging indicators. So the way people build this is they look at amount of LP dollars deployed, and then they minus dollars deployed by VCs. I'd say one thing that's tricky to think about when you're estimating something like this is that the average VC was really deploying super quickly in the last 2 years. The average deployment cycle, if you looked 10 years ago, was funds would deploy their full fund in 3, 4, 5 year time horizons. Over the past 2 years, we were really seeing VCs deploy in 12 to 18 months. So the billions of dollars of capital were getting deployed in record speed as funds were kind of competing in market. And so this lagging indicator might actually mean that some of these dollars actually aren't dry. They've already been deployed. Second thing that's going on is VCs actually may not want to come back to market as quickly. Many of you will know that VCs actually also have a fundraising cycle, so it's not just companies. And so they were previously coming back to market to LPs relatively quickly. But because we're not seeing as many exits, we're not seeing as many IPOs, they may not be they may not be in as much of a rush to come back to market. And the third dynamic that's happening is the capital from lots of other places, crossover funds, strategics, now has basically exited the market. They were super active, especially the crossovers over the past 2 or 3 years. This really drove valuations. This drove competition, and they've obviously left the ecosystem. So there's a few interesting dynamics that this chart doesn't really show that I think are worth highlighting. So if we keep going, what does this mean for what investors are thinking about? I think these are conversations that we're having pretty actively amongst investors at our partners meetings. I think what it really means is 2021, of course, is different than is very different than 2022, and it's really a very different mode of thinking. It's not really growth at all costs anymore. You'll hear Nico just talked about it in the last session, but it's really a return to the basics. It's really and we're really looking for business models that work and return to business fundamentals. So what does this mean? It's about gross margins. So do you have gross margins that look like software 80% plus? If you don't have that, do you have really tech-enabled gross margins above 50%? Anything below that, I think, is going to be quite tricky. Can you show a path to positive gross margins? Like, unit economics are now really important. Can you show a CAC LTV numbers and payback that are in the consumer space less than 12 months? In the B2B space, we're going to be looking at sales efficiency. We're also going to be looking really closely at churn and retention numbers. So I think 2-year LTVs are really what you want to be showing. That's really what I'm going to be looking at as well. And it's hard to convince an investor at this point to look at a 5-year LTV type number unless you can really demonstrate evidence that churn is really low because of your business model or because of the mousetrap that you built. Capital efficiency is in vogue again. So investors are really looking at and discussing burn multiples. How much revenue did you add? How much did you really burn in the process to get there? And of course, it's kind of a two-edged sword. We're also still looking for growth. So in the early stages, I think you still want to be growing 2 or 3 times. Like, I think in previous iterations in 2021, the bar for traction was a lot lower. The bar for traction now, I think, is quite different. For seed, of course, it's product milestones and team. For Series A, I think we're going back to really investing post product market fit. And then in Series B onwards, we're really looking at your ability to scale profitably with good unit economics in a capital efficient way. And the last thing I want to highlight here is we don't really have a crystal ball. We don't really know where valuations are going. And if we're heading into a recession, I think it's meant the late stage investors, there's really been a fundamental disconnect between founders and investors in the late stage. But I would also say there's quite a bit of uncertainty in terms of what the price, quote unquote, should be, which has led to not only, as the last session would have said, a game of chicken, but it's led to actually some hesitance and a lot more patience on the part of investors, because it's hard to know really what to price things at and where the market's going to go. So there isn't really as much pressure to deploy as there would have been previously. Again, we're not looking as investors there's not as much pressure to go back to LPs and fundraise again, especially not in this market environment. And so what does this mean for founders? So I wanted to give a few pieces of practical advice, which are really conversations that we're having in our boardrooms today. The first thing is plan for things to really take longer than in 21. This means you probably want to look and think about runway planning and runway management more than you would have before. In 2021, capital was pretty plentiful. You could raise at almost any time if you were a good founder, and I think you still can definitely raise. Deals are still getting done for great founders, as always, but It's just taking longer, even for good founders. It's probably not going to be an auction situation where you can run a super tight 1 week term sheet process. I would still encourage everybody to run a proper process and to be engaging multiple parties at once and trying to really push folks. I think one of the other things that isn't on here, but that I really think about is if you're not getting interest, definitely follow up, but don't. It's all about using your time wisely as well. If you're not getting bites, focus on those investors that you really think are actually interested in and you've built a relationship over time. You will have to prod a lot more in this market environment, though. VCs are going to take a lot more time to build conviction, and you want to build and you really want to, again, start to build relationships early and engage versus try to run like a super tight several day process, which was really a 2021 fundraising tactic. I think being pragmatic and starting with reasonable valuation expectations. I think, again, nobody has a crystal ball. It's hard to know what reasonable is. It's probably not what 2021 was. I think 2018, 2019 might be a useful guide. It's going to be smaller rounds and slightly lower valuations. I would start there. Best case scenario, you again start your process. It should be structured. You should be engaging with multiple people, and that ends up being and you end up being able to run something where you have multiple bids. But starting with reasonable expectations, I think, is a good starting point. I think a couple of other things are in your discussions. If you are a Series A, Series B, Series C company, you might think about how flat rounds mode, you're going to need to do more with less. So there is less room for experimentation. Although I still would say it's pretty important to maintain a culture where you're still rolling with the punches and devoting some dollars to experiment, but you're not going to be able to do as much. So focus and prioritization is key. And I think investors are thinking about that as well. And then finally, if you can be opportunistic, I think this is one of the best times in history to hire amazing talent, especially if you think about late stage companies where equity might be underwater, and or if you're in the position to both hire great talent or think about M&A, you should try to be opportunistic where you can be. And I wanted to end with a few highlights here that I think really apply in a bear or a bull market, but I think are particularly germane right now. Like, headlines should really tell your story, especially in an environment where it is now more of an investor environment than it has been in the last 2 or 3 years. This applies again in all circumstances, but make sure you're telling a clear story in your headlines. I think now there is more of a focus on business fundamentals. So really highlight, if you have them, your unit economics, your margin, how that's going to change over time, and tell a path and really highlight that in what you're describing. I think, especially if you're an A or B or later company, I think showing focus and prioritization, again, it's all the theme of the bear market is really doing more with less, and really, I think having a big roadmap where you're doing a bunch of different things is going to be less. You're not going to get as much credit for that as you might have in previous years when funding was fully available. And then finally, I think get ahead of investor questions around the market. If you're in a cyclical market industry, talk a little bit about your plan to mitigate that. And so maybe leaving you guys with a few final thoughts. We're still doing deals. Investors are active, but again, there is a little bit of a market uncertainty. There's definitely a lot of market uncertainty and an environment that's a little bit different. I think highlight business fundamentals where you can. It's definitely sell your vision, but again, we want to invest in great businesses, and that's really what we're seeing across the spectrum in terms of deals that are getting done. And then focus on the most important things, and I think prioritization is key in this type of market. So maybe I'm happy to take any questions if there are any.
Perfect. Thank you so much, Steph. That was so informative in terms of what's going on in the market, what to expect, and, for founders out there everywhere who are probably looking for funding, regardless of the stage that they're in. But that brings me to two questions before we wrap up. One of them would be, are there certain industries in specific, I know you mentioned them at the beginning, that you're more bullish and more leaning towards to invest in more than others? And secondly, being at Portage as long as you have, and being from one of the first people there at the time, what keeps your drive going through the ups and downs of this market?
So maybe I'll answer the first one. I think the businesses that I think are getting funded today, and they're definitely things that this applies to kind of our investment strategy as well, and I'll talk about where we differ, are businesses that are kind of evergreen in thesis. So in the fintech space, I think there are definitely sectors of B2B SaaS. There are sectors that are like payments, B2B payments, for instance, that no matter what the market environment is, these are still great companies that are solving a really big market need and are not going to be hit by cyclicality. I'm actually looking, and insurance is another good example of this. Whether or not you're in a bull or bear market, you still need to buy insurance for your home, your car, your business. And so these are kind of evergreen theses. I think that there are a number of other kind of counter-cyclical theses in this kind of recessionary environment. You think about, like, consumers are looking for deals. There's a lot of consumer, like, recession-proof industries. So, like, you think about retail, dollar stores always do really well during recessions. And how does this apply to tech? Like, debt management, debt resolution becomes a like lines of credit. Like, these are counter-cyclical kinds of industries that start to really take off in moments like this, when consumers are feeling a pinch. And then finally, I would say we've always been a little bit contrarian in how we invest. So we're always still, I think the consumer markets have been not as hot over the last year, certainly, but I'm still looking to invest in great consumer businesses, because our feeling is that the macro environment is going to turn, and in the next decade, and it really hasn't changed how people interact with technology. And in the next decade, you're still going to want to be in the best consumer businesses of the next 10 years. So from a macro perspective, if you take a long-term perspective, you still want to be in businesses that you think are great, even if now is not the right moment, or you're going to spend 2 years being kind of flat in them. And then I guess the second question, to answer your question, I think it's kind of this is actually a great moment to be an investor in some cases. I really do think moments like this in bear markets are when the best companies are started. And you can look in history, 2002, 2003, 2004, 2010, 2011, some of the best companies and the highest market cap companies in the world have been founded in times like this, because I think you're seeing a really interesting pool of founders. And really, it's the best companies that end up surviving in this kind of funding environment. So I think it's actually a super exciting time to be both a founder and an investor.
100%. Thank you so much for answering those. I don't know if we have a minute for another question that came up in terms of the crypto market and maybe the blockchain, which is maybe the $1 million question for a lot of people out there, wondering where that's headed.
Yeah, look, I'm super bullish I'm a fintech investor, but we've been doing crypto and Web3 stuff for a while out of the fund. I'm super bullish about this from a macro perspective. Again, this totally applies to the like all the comments that I just made about consumer, I think really apply to crypto as well, which is over the long-term time horizon. We're going to see a lot. Like, I'm very bullish that this is going to be super transformative, and essentially as transformative as cloud, mobile, social, in terms of tech. It's going to be, but I would say one of the things that it's going to be a super rocky path to get there. And so I think that the place where people really wonder, and that I would predict it's going to be shorter than later, is what's the time horizon in which this really disrupts everything we're seeing in the financial world, and in the technology world in terms of incentive structures. And some people think it's going to take a decade or more. Like, are we at like Palm Pilot, or are we at first iPhone? And I would argue it's going to be within this decade that we're really going to be seeing crypto reach real mainstream consciousness. So macro perspective, I'm pretty bullish, but micro, it's going to be a super volatile couple of years.
Thank you so much, Stephanie. I'm one of the optimists as well. We've learned a lot from you today, and I hope everyone has as well. Thank you so much for your time, and we hope to see you again soon.
Thanks for having me, and thanks to Startup Grind as well. Enjoy the rest of your day.
Thank you.